Welcome to the Funeral Funds Life Insurance Podcast. I'm your host, Randy Vandervate from Funeral Funds of America, and you can find us at funeralfunds.com. That's funeral, Funds.com. Whether you're interested in term life, whole life, mortgage protection, annuities, disability, business continuation, or final expense life insurance, we have you covered. Our team of experienced life insurance professionals will guide you through the complexities of insurance products to help you make an informed decision. In this podcast, I'm going to be discussing what is mortgage protection. And if you've ever bought a house or financed a loan or anything like that, you know that you just absolutely get pummeled by letters saying, hey, you should get this mortgage protection, or saying, hey, you're entitled to these benefits, or saying, hey, you're dumb if you don't get this. There's a lot of different kind of marketing tacks on that. But um, yeah. So let's kind of start out by talking about what actually mortgage protection insurance is. And let's help you clear up a whole bunch of that confusion, and then clear up a whole bunch of confusion about the marketing letters you get. And we'll clear up kind of what happens after you send one of those marketing letters in, because you're hoochie your mama. You're in for a surprise in most cases. So mortgage protection insurance is simply a type of life insurance designed to safeguard homeowners and their families when the mortgage holder, the primary mortgage holder or holders, die unexpectedly. Now, mortgage protection insurance is not PMI. So PMI is private mortgage insurance. And a lot of the loan companies out there, they actually require that if you put down less than 20% of the home value, that you actually have to buy this extra PMI, private mortgage insurance. And the reason they do that is because you've put so little down. There's less kind of you got less how should we say, you've got, you're just a higher risk because you've just got less kind of, stake in the game, I guess. And what that means is that, if you only put 3% down on a mortgage on a $500,000 house, you probably wouldn't feel too bad if you walked away from it. But on a $500,000 house at 20% down, if you put $100,000 down on it, then you're definitely more anchored into that house. So, PMI is just essentially a way for the mortgage company to recoup a lot of the costs if they have to get that house back and sell it. Because think about it, if you got a $500,000 house and you put $100,000 in, well, $500,000 house at 6% sales fee, which is your real estate fee, that'd be $30,000 right there. So the mortgage holder, if they repo the house, it's going to cost them $30,000 to sell the home. And that does not even include any upgrades, or if there's been any damage to the home, or the legal and lawyer costs, and just everything along the way. So it could easily cost them 40, 50, 60, $70,000 perhaps to get the house sold, time on the market, just everything. There's also that time value of money. The longer it sits, the less they're making money on it. So the PMI really just it's an insurance policy that protects the mortgage company. And if you put just a little bit down, it kind of covers the difference on their end. Doesn't benefit you at all. But by the way, um, once you reach on your mortgage, once you pay down 20%, you can request that PMI get dropped. They may not do it automatically. Pay attention to that and make sure and get that drop, because it's costing you, it could cost, $100, $200 a month, depending on your loan. The other thing too is also consider on the PMI, totally unrelated to mortgage protection insurance, just trying to help you out here, that if your house value goes up and you pay it down a little bit, right? Because in the early years, you're paying that mortgage off really slow. But a lot of times the appreciation in house value will get you up to that, that 20%. Now your mortgage is, only 80% of the total value. Therefore, you've got the 20%. And you can also request your PMI to drop there. And now you can make the same mortgage payment as if you were paying that PMI, but throw that extra PMI money at the principal on your mortgage and pay your house off sooner. Ooh, quick, cool, right? or you can get mortgage protection insurance. But so back to mortgage protection. So these policies are really designed to pay out if somebody were to pass away. Just because it just happens, right? If you've got a couple and they're both working and one of them passes away, you might be able to afford the household and everything with two incomes, but not one income. So if somebody passes away, in so many cases, the house is lost. It goes back to the mortgagor's got to be sold, and people need to get out from underneath it. But let's say that each spouse or partner made the same amount of money, 50-50. If you just had a mortgage protection policy, an insurance policy, that if one of those people passed away, even half the mortgage would get paid off. So let's talk a $500,000 house. If you had a $250,000 mortgage protection policy on each homeowner or each person, each partner, couple, married, whatever, you could use that money to pay off half the mortgage. Then the surviving person could refinance the mortgage, cut that in half, and now they could stay in the house. So you're not restricted to just paying half the mortgage. You could get both of the couples, both people, and you could, again, $500,000 house, you could get $500,000 policies on each person. And that way, if the other person passed away, now that death benefit could be used to pay off the house, and the house would be paid off free and clear. And what an amazing legacy to leave behind. God forbid, when the worst happens, you only got one choice, and that's try to make lemonade out of lemons, right? So if somebody does pass away, what an amazing generational, just legacy changing gift to make sure that somebody's got a completely paid for house. Pretty amazing. So that's the power of mortgage protection insurance. And they're all built off life insurance policies. Could be term life, could be whole life, just depends on your situation. And one other thing to consider, though, is when you look at the statistics about the homes being lost, more homes are actually lost to disability than death. So a disability policy can also be considered mortgage protection, even though that disability can be used to pay like anything, all right? The car payment, the utilities, whatever it is. But bottom line is there's a lot of people out there that are living paycheck to paycheck, and that's most of the United States on average. And if you just even miss 1 month or 2 months or 3 months, in many cases the house is in immediate danger. So disability insurance certainly falls in there, and we can help you with any of that as well too. But the coverage is just going to depend on a number of things. It's going to depend on the mortgage, the size of the mortgage. It's going to depend on how the income distribution is in the family. If you're just a single homeowner and you'd want to make sure that the house got paid off, so that it could go to your kids, well, that's pretty straightforward. That's just you know get yourself insured for however much you want of that mortgage. If it's going to be, a couple, well, maybe that each couple makes 50-50 of the total household income. Maybe it's 70-30, maybe one spouse or partner makes 70% in the income, the other makes 30%. And if the 30% person, if they passed away and couldn't contribute, the 70% income person might be able to get by. But if it's the other way around, if the 70% income person dies and the 30%'s left with the mortgage and everything else, they're going to suffer tremendously and lose the home for sure, for sure. So, there's no blanket formula. It's really uniquely different on each different situation, no matter who we're talking with, either homeowners or, the value of the house or anything. I'm just using generically $500,000, but it could be a $130,000 mortgage, or it could be a $1.3 million mortgage. And really, when you think about it, both of those people could be in the same financial situation, meaning they both could be living month to month. It's just that a lot of times people that make more money have more bills, right? So, um, kind of there's a few key points about mortgage protection. The purpose of mortgage protection, again, is just to protect, those who are left behind who have a stake in the mortgage, to make sure that they're able to stay in the house. And again, it doesn't always mean that the house is totally paid off. Sometimes you don't need to pay the whole house off. Sometimes you just need to cover half or three quarters or whatever it might be. And when that happens, a death benefit's paid. In the form of the check, it goes to whoever's the beneficiary on the policy, and then the person who is the beneficiary can do with that money whatever they want. So let's say you had a $500,000 mortgage. At some point in the past, you took a $500,000 mortgage protection policy on it, but then you paid, let's say you paid off 250,000 of that, and you still had more to pay. You still have a $500,000 policy. So there's $250,000. What happens to that? Still goes to the beneficiary. The beneficiary is still going to get $500,000. Now, what's cool about that is that extra $250,000 can be used for anything, maybe income replacement. So not only did the person pass away, but and because they had the $500,000 policy, the mortgage of $250,000 got paid off. But if they earn $100,000 a year, now you've got like 2.5 years worth of their income that's going to be able to just carry you on and help you get, replace some of that income so that you don't take this drastic cut in quality of living or anything like that. And again, disability, that can be that some policies out there have critical illness components built in. Just depends on the company and the wording on whether those are really, super beneficial, especially in the early years. But straight out disability insurance is going to cover a lot of those deficits if something like that happened. Critical illness, just some of them, just, if you diagnose with something terribly significant, it just goes by different words based off and terminologies based on the insurance company. Um, just understand that, this is voluntary insurance, unlike private mortgage insurance. When you've got, less than 20% down, they're going to force you to get that insurance. And, if they're forcing you to get that insurance, you should get out of that insurance as quickly as possible because it does nothing to you. It just protects the bank. Um, if the mortgage company does offer some sort of life insurance, mortgage protection insurance in the event of death, just understand it's going to be accidental death. What the first true house I ever bought way back in the day, they said, hey, we've got this thing. If you die, we'll pay the mortgage off. And I was just kind of young and naive at the time. I go, cool, yeah, let's do it. It was like $15 a month, whatever it was. And I'm like, yeah, cool, let's do it. And they didn't ask any health questions, nothing like that. I just didn't know at the time. I was not in insurance at the time. And I thought it was cool. I just, it'll pay off no matter what. Peace of mind. Well, come to find out, that's accidental death only. If it's $15 a month or super low rate, that is, yeah, that's accidental death. That will only pay if you die of a catastrophic or accidental cause of death, which most people don't die of accidental death. They die of medical events. And if you died of a medical event, that policy wouldn't even pay out at all. So let's talk about kind of premium and coverage here. So the cost of mortgage protection insurance, which is it's just, I want to make this clear. Mortgage protection insurance is all based off a life insurance product because there's no other product out there that's going to pay off in the event of a death. If you die, what's going to pay out? Life insurance. It's nothing else. So when it's called mortgage protection insurance, it's a life insurance product, but the mortgage protection insurance is just a description of what the life insurance is intended to do. Doesn't make it good, doesn't make it bad. It just is what it is. If you want a policy that's going to pay off when you die, it's a life insurance. And we're just setting these funds aside separately, to go towards the mortgage should somebody pass away. So with that in mind, what factors affect mortgage protection insurance and life insurance rates? Well, certainly age and health, right? The younger you are and the healthier you are, the less you'll pay in premiums. So if you're 35 years old and you just bought a $500,000 house, your mortgage protection life insurance policy is going to be less than if you were 65 years old and just bought the same house, $500,000, right? So that is one of the things that we help our clients play around with and find out, what we can do to help them make the most of their money and get the most affordable policy. Because in many cases, you don't need to cover the whole mortgage. Because think about this: if you got a $500,000 house and you take half a $1 million mortgage, and you put $100,000 down, so now you've got $400,000, and that's the size policy you get. Well, at some point, you'll have that house paid down to $200,000. So in some cases, what we'll take a look, and of course, we don't know what tomorrow holds, but just trying to save money, because there's always going to be that balance between kind of paying mortgage protection insurance and paying the house off early too. So if you had a $400,000 mortgage and you paid it off early, you made extra payment, now you got down to 200,000, there's extra money left over there. But by the same token, if you had that $500,000 house with the $400,000 mortgage, you may look at that and go, well, what if we did a $200,000 mortgage protection? And God forbid, if you just flat done went and died a month from now, there's going to be $200,000 to pay off the mortgage and then refinance it. And again, the surviving partner can now afford to stay there. So that's just kind of a sliding scale based off, your income and budget and everything else. But also consider this: by only covering half the mortgage, now you've freed up some additional dollars to apply towards the principal on the loan so that you can pay the house off quicker. So the faster you pay the house off, the closer you get to that $200,000 of insurance that you have. So I don't want you to get lost in all the kind of mental games and kind of numbers and scenarios and everything. That's something that we help people with. But the most important rule of mortgage protection is have mortgage protection, not just think about it and everything else. The other thing too is policy duration. So let's say you did a $500,000 mortgage, or you have a $500,000 home with a $400,000 mortgage, and you're going to plan on paying that over 30 years. Well, you could save money by getting a 15-year mortgage protection policy, even though the mortgage is a 30-year. You go, well, why would you do that? I want the house paid off. Well, because think about this. In 15 years, you're going to have that mortgage paid down significantly. And God forbid, if something happened, you could then refinance the house at that point and significantly drop your payments. And then it would probably fit in your budget at that time. It's just another way of saving money. And again, the lower mortgage protection you have, the more you can apply towards the principal of the house and the quicker you can pay it off. So keep that in mind. We also help people too. So this would be more seniors and everything too, but it applies to younger folks as well too. In some cases, we talk to folks and they'll say, well, if something happened to me, my surviving spouse or partner wouldn't stay in the house. We would sell the house. It's just too much house, and then, the memories and everything else. We just, both of us would not want to stay in the house, if the other one passed away. Well, if that's the case, do you really need to protect the whole mortgage, or do you really just need to protect maybe 6 months, 12 months, 18 months, 24 months of the mortgage payments? So let's say you got a policy that was only, typically we would do this with more elderly folks, seniors, and say, hey, let's get a policy that's going to pay 12, 18, or 24 months of the mortgage. What that will do, it will allow you time to grieve. Okay. It will allow you time. It's called the critical period concept. It's during that critical period when you're grieving and everything's going on, you want to be able to keep the house, because at some point, if you paid off a house enough, the actual real value of the house is going to be in the principal. And if you sell the home, you get to keep the principal. You get to keep those hundreds of thousands of dollars. That's almost like the life insurance policy right there. You want to protect that principal. So in many cases, we just say, hey, let's cover 12, 18, 24 months. That will allow you time to grieve right off the bat. And then it will also allow you time to sell the house, because what if the house takes, 6, 8, 9 months, a year to sell? We want to make sure that that can be done. And we've helped people. Really, in some cases, with 3 to 6 months. That's what they figure. That if I can just get 3 months or 6 months, that's all they'll need to sell the house. So keep that in mind too. That's an option, especially as we get older, because to do the complete mortgage when you're in your 60s, 70s, 80s, that can be very difficult for folks. So just covering that critical period concept is really, really provides some peace of mind for folks in that situation. As far as the policies themselves, they're level premiums, which means the premiums never go up. Coverage never goes down for the specified term. If it's term life, typically it's 10, 15, 20, 30 years, depending on what it is. If it's whole life, there's no expiration at all. And, just keep in mind, this is all of what we're talking about. It's different than homeowners insurance. Homeowners insurance is going to pay out if you've been hit by a flood or a tornado or electrical or a hot water tank burst or something like that. None of that's going to make your mortgage payments, right? So, there you go. Boy, that was a lot, awfully quick. Well, I'm going to touch more on this in some upcoming episodes because there's a lot of confusion about this. But let me do touch on one fact as I leave you go here. As I mentioned earlier, when you finance a mortgage or take out a home equity line of credit, a HELOC, anything like that, all that information is with the bank initially or the funder, the loan company, whoever that is. But once you do that loan or initiate the loan or the mortgage, now it goes to the county courthouse and the court, all that stuff's recorded at the county courthouse. What happens there? Well, all that becomes public information. So, all those letters that you get in the mail, there are people buying that information from the counties. And even though they make it sound like you are oh so special, that it's your mortgage and we're here for you and we're going to protect you and you got to do this. They make you feel oh so special. Just understand they're sending that to everyone. And they may send that out, right off immediately upon, that loan going in. And you'll just get hammered with stuff in the mail. And then they may send out a second mailing in like 6 months, and they may send out a third mailing like in 12 months. So that's why you're constantly getting these letters because they want to get your information. And then once you fill out one of those pieces of paper and you can fill it out and you can mail it in, a lot of them have online applications. What ends up happening then is they then sell that lead to a life insurance agent. And, that life insurance agent may be paying 40, 50, 60, $70 for that. And, can you imagine paying, say $70 for somebody's information? Are you going to call them frequently and aggressively to try to get your investment out there to try to sell them life insurance to make that money back? Heck yeah. So just understand there's some companies out there that, if one agent buys that lead and they may have 30 days to work that lead. That lead is you. Remember, that lead is your information, your personal information. And then if they don't sell it at that point, now that lead becomes available to a second agent. It's called an aged lead at that point. And now somebody else can buy that. And they may buy that lead at, say, $40 if the first person paid, 70. And then, and if they don't sell it within a specific period of time, then it goes to a third agent, and then it can go fourth, and then a fifth agent. So potentially you could have 5 agents calling you, at some point in the future because you sent this form in, either you mailed it in or you filled it out online. And boy, we hear from so many people because we don't do that. People call us and ask for help. So we don't need to pay for a lead. People just ask us for help. So just understand that there's kind of it's conflicting in a really way because we know the insurance people, they do want to help you. They want to make money and everything else. But man, they've in many cases, they paid a lot of money, invested a lot of time, and it can get very, very aggressive out there. And boy, it's frustrating to so many homeowners that they didn't know what was actually going on when they sent that in. They sent their information either online or in a letter, and then their phones start blowing up and emails. And I mean, these agents will even come out and knock on your door. They'll knock on your door if you don't answer them, if you haven't, because remember, they paid a lot of money for it. They'll hang these little things on your door like, hey, we missed you. They'll get these little sticky notes and they'll stick it on like, hey, you missed the delivery. Well, the delivery is a sales pitch. So just be aware of that. There's a lot of tricks and stuff. And, I started out in this business years and years ago doing mortgage protection. So I know what goes on here, and I know how frustrating it is. I know what it's like from both sides. I know what it's like from the agent side And I know what it's like from the homeowner side, just getting deluged and everything. So that's one reason why we at funeral funds, we do things totally different, because back in the day when I was doing that, I didn't even like the process, but that's the only thing I knew at the time. And things have changed so much since COVID hit, that you don't have to visit in person. A lot of these agents and stuff, they're now doing it online. Well, that means you're gonna get on a Zoom presentation with them. You're gonna have to go face to face, and, there's, certainly you can disconnect, but there's a lot of times people just feel like they've been pressured into something, especially if you let somebody in your home. A lot of these agents, they really wanna visit you in your home because they wanna get in your kitchen table and sit down and, like, being talking with you, and, kinda using some sales techniques and stuff to kinda pressure you into buying. And, you know, although it can be convenient, it's not always the best solution, because so many of these agents, especially the newer ones out there, which mortgage protection tends to attract younger, more experienced agents. Therefore, these agents are encouraged by their uplines to, like, go and knock doors and call frequently. And a lot of times they're going to tell you to dial you 3 times in a row. So if you've ever done this and sent a form in and you get the same phone number, why are they doing that? Because they're, like, trying to, like, make you think it's an emergency and get you to pick up the phone. So there's a whole lot of tricks and stuff that goes on. I don't know. Is it ethical? I guess they're just trying to make money, and you agreed to send your information out, kind of not knowing what lied in store for you. And again, a lot of homeowners get really frustrated because they just wanted some simple help. And they didn't want somebody necessarily to come and visit their home. They didn't want to do a Zoom. They didn't want to be pressured. They wanted help. They wanted information. They wanted to maybe think about it a little bit. And they're just getting pressured, aggressively getting called and marketed to. And it doesn't have to be that way. It doesn't have to be that way. If you want a different experience, certainly reach out to us. But that's kind of my thoughts on, well, what is mortgage protection insurance. So my name is Randy Vandervate. I hope this podcast has been helpful to you. Funeral Funds of America can help you qualify for first aid coverage or benefits at funeralfunds.com. That's funeral funds.com. And our phone number is 888-862-9456. We will be blessed to help you with this in the future. Until that day comes, stay safe, take care, and have a nice day. Bye-bye.